Let's get more on what's happening in the sector from Jude Anele. He's the head of retail banking with Diamond Bank. Jude, it's great to have you on the show. Let's get right into it. We're just talking about the banking sector. Now, there's a lot of concern over the effect that some of the CBN's recent directives will have on the sector, namely the CR, we have the MPR, we have the NOPL changing, standard lending facility in the WDAS auction. Also, we're seeing some changes in that area. What impact is this having on the retail banking sector specifically?
Okay, thank you very much for having me. Good evening. The recent changes that the Monetary Policy Committee has made, especially in the area of the cash reserve requirement, has a very great impact on retail banking. But I'll just speak through some of the changes and then narrow it down to the cash reserve requirement. First of all, the net open position was dropped from 3% to 1%, and the intention of that is just to clip the banks from having arbitrage activities in the forex market area. Also, the requirement that states that if you have accessed the CBN's discount window, you can also trade on the WDAS. Also ensures that you don't take money from CBN and then play around the FX area. But narrowing that to cash reserve requirement, the intention also is to ensure that banks don't go to town and play around with the cash or liquid cash that they have in their position. But what that speaks to largely is the fact that banks are now meant to tie down 12% of their depositors' funds in cash with the central bank. The effect it has on retail banking is that banks will now depend largely on retail deposits, which are in the main low cost and stable for the major source of their deposits. Because if you depend on corporate deposits that are purchased funds and high in cost, then you are going to pay a heavy penalty sterilizing that cash with central bank. So I think this will make a lot of banks have a greater retail focus, because that's the only place you can generate low-cost deposits that even if sterilized with central bank up to 12%, your net interest margin will still be good.
So I guess, Jude, you're saying that it will have both a good and bad effect on the retail banking sector. But according to news reports, some of the data released by the CBN says that private sector credit growth was actually up to 49.8% in June 2012 when we look at it year on year. Now, Fitch actually released a warning earlier last week saying that Nigerian banks should be careful that we don't see a repeat of what happened in 2008, where we saw an increase in the non-performing loans. Now, this raised my eyebrows, and certainly others felt the same. We saw RENCAP saying that they feel it was an anomaly that involved the way CBN recorded AMCON bonds, and that's why we saw private sector credit growth increasing. Now, what trends are we seeing in the retail banking sector? And certainly, I'd love to know what you feel about this statistic that private sector credit growth is going up.
I believe very strongly that RENCAP nailed it. I think the 49.7% growth that CBN stated was as a result of the treatment they had of AMCON bonds that banks posted with them way back in November 2011. But if you treated that month on month, starting from January 2012, you find that credit growth to the private sector is no more than 20% year on year. However, in the retail segment, there is absolute growth in retail assets, in the sense that that's where the banks actually derive greater margin. A lot of banks haven't been playing in the retail asset segment for a long time because they've been worried, and there's been issues of identification and collateral. But I think most of them are making the brave start to begin to lend in that area, because that's the only area where you are guaranteed the very wide margin. So I think that credit itself is growing, but not as high as 50% as central bank has anticipated. It's just about 20–25% at the max.
Well, Jude, now that we're seeing interest rates going up, what are your thoughts on whether there's any risk of an increase in loan delinquency or any loan delinquency at all when it comes to the banking sector, and of course in the retail banking sector as well?
I don't anticipate that to happen, because if you check the bank's performances for the first half of the year 2012, you find that the delinquency rate has actually dropped. Most of them is dropping below 6% to 5%. I think banks have been very careful in lending. And just to give you information, with the recently circulated exposure draft on bank tariff and charges, CBN is planning to cap lending rates at about 21%. So if that happens towards the end of this year or beginning of next year, you find that the runaway interest rate that we see in lending will stop. So I don't see interest rates climbing very high. That is one. I also don't see delinquency rising, because a lot of banks, in fact, by regulation, have been compelled to keep their delinquency rate below 5%. or you sell the excess to AMCON. So that CBN has already dealt with that. I don't think we'll see that happening in the future.
Well, Jude, very quickly, at what range do you see interest rates going or sort of hovering at? We do know they're heading up, of course, with the CRR going up as well. What is your take?
Well, I think interest rate will rise very, very slightly. It will have risen more if they increase the monetary policy rate, which is still at 12%. If that had risen to, say, 13 or 14%, we'll have seen interest rate in retail lending rising up to 30%, and the corporate space rising up to 18 to 20%. But the way it is, I think it will stay at prime lending of about 18 to 19% in the corporate area, and then the retail space, maybe maximum 28%.
Well, thank you so much, Jude, for giving us your take there. That was Jude Anele, Head of Retail Banking at Diamond Bank.